Hi everyone, welcome back to my channel. Today I'm answering the top most searched questions on Google about personal finance. Whether it's your first time or you need a refresher, it's better to keep watching this video because I'm sure you will learn something new about personal finance that you haven't found out before. Okay, the first question is, what is a debit card? A debit card is a card linked directly to your checking account. Every time you swipe it, money is immediately deducted from your account balance. Unlike credit card, there's no borrowing involved, which means there's no interest payments. Next question is, how much money do you need to open a savings account? Well, this is a great question. The amount you need to open a savings account can vary by bank, but typically you can open one with as little as $25 to $100. And sometimes there are certain banks with no minimum balance. I would personally save my money in a high yield savings account. The third question is, what is a line of credit? A line of credit is a flexible loan you can access when you need it up to a certain limit. You only pay interest on what you borrow and you can draw from it as many times as needed. It's great for emergencies or for large expenses like home repairs. The next question is, what is a budget? Well, a budget is a plan for your money. It helps you track your income and expenses so you make sure you're not overspending. The goal is to allocate your money effectively, some for savings, some for your bill payments, and some for, little fun. Question 5, what is an APR? APR stands for annual percentage rate. It's the interest rate you pay on loans or credit cards, and it's expressed annually. It includes not just the interest but also any other fees or cost involved, which helps you compare the true cost of borrowing. Question 6, how to invest? I would say start with low cost index funds or ETFs. Diversify your money across stocks, bonds, and other assets. Make consistent contributions and hold long term for growth. The next question is how to make money. You can pick up a side hustle, freelancing, or investing in stocks. And you can also create digital products or start a small business. Next is, should I pay my credit card first or should I save? Well, for high debt payments such as credit card, it's better to pay it off first and then you start building your emergency fund. But if your interest rate is low on the debts, then you can start saving for emergency simultaneously. The next question is, what size of mortgage can I afford? The rule of thumb is that it should not be more than 28% of your monthly income. And you also need to factor in taxes, insurance, and other costs as well. The next question is, what is a W-9 form? W-9 form gives you taxpayer identification number to a business or person so they can report payments to the IRS. It's usually used by freelancers and independent contractors. Okay, these next 10 questions relate more to investing. So the first one is, what's the difference between savings and investing? I would say that saving is putting money in a piggy bank or saving account for short-term goals, like if you want to buy a car or maybe some home improvement, or maybe saving for a down payment of a house. They usually will give you less return compared to investments, but they are more guaranteed. Investing, on the other hand, involves purchasing assets like stocks or bonds with the aim of growing your wealth over time. Now, when should I invest? I would say it's often a good idea to start investing as soon as you have an emergency fund saved that can cover a minimum of 3 months worth of your living expenses. The earlier you invest, the more time your money has to grow because of the power of compounding. Okay, the next question is, how much should I invest? A good rule of thumb is to invest 15% of your income for retirement. This can vary depending on your financial goals and risk tolerance, and you can slowly increase it to up to 30% if it permits your lifestyle. What is a stock? A stock represents a small ownership in a company. If you buy Apple stock, you own a tiny part of Apple Incorporation that you have invested. Now, how should I start? You can start by opening a brokerage account with an online platform like Vanguard, Schwab, or Fidelity. Begin with low-cost index funds that track the overall market. S&P 500 index fund is one of my favorites. It historically has given an annual rate of 10 to 11% on an average over the long term. And it's well diversified because it tracks the top 500 companies in the US. Okay, what's the difference between stocks and bonds? Stocks are shares of a company and their value can go up or down depending on the company's success. Bonds are loans to a company or government which pay you interest over time. If a company goes bankrupt, bondholders get paid first as they are the ones who have lent the money to the company. Okay, should I invest while paying off debt? I would say if your debt has a low interest rate like a mortgage, you can do both. If it's high interest debt like credit cards, definitely prioritize paying that first because any investment that you make will not be able to guarantee that high return, which for credit card interest could go up to 24% these days. The next question is, how do I manage risk in my investments? The best strategy is to diversify your portfolio by investing in different asset classes like stocks, bonds, and real estate. This spreads your risk. When you are young in your 20s or 30s, you can invest more aggressively in stocks to get the maximum return over the long term. And then, as you grow closer to retirement age, try to be more conservative and then you can invest in bonds and safer assets. Okay, the next question is, what are dividends? Dividends are payments a company makes to its shareholders from their profits. If you own Coca-Cola stock, you may receive quarterly dividends as part of the company's profit distribution. How can I make my investments grow faster? I would say you should invest more money and for a longer time in a well-diversified portfolio. Choose higher risk investments like a mix of stocks for potential higher returns, or leave your investments untouched to get the compounding over time. I hope all of this helped, and if you like today's video, please don't forget to hit the like button and subscribe to my channel for more such valuable content, and I will see you in my next one. Take care. Bye.